A labor market apocalypse. October job cuts explode to the highest level since 2003 and are now surpassing 1 million for the year. Is the long feared AI unemployment shock here? One shocking chart seems vindicated. So, as if the universe doesn't have a sense of humor, yesterday we had a relatively decent ADP private payrolls report, 42,000 jobs added. And in the video, I noted the weakening trend that we can see from the moving averages, of course, and asked, are we starting to see a bounce? Well, one of the reasons was a decline in the amount of job cut announcements from both Macro Edge and Challenger Gray and Christmas. And again, as if the universe doesn't have a sense of humor, we get a new Challenger job cut report and we can see it is surging. So this is zoomed in from July of 2022 all the way up through now. And of course, we can see for October, it just absolutely skyrocketing in terms of layoffs. Now, this is the highest for the month of October, going all the way back 22 years, all the way back to 2003. It is led by warehousing and technology sectors, as we can see here, chart provided by Zero Hedge. And here are the top five various industries facing layoffs. So to get into the actual report, we can see that job cuts surpass 1 million, the highest October total since 2003. Companies are citing cost cutting and AI, and we'll get to that shocking chart that might seem pretty vindicated this morning. So US based employers announced 153,000 job cuts in October, up 175% from the same time last year. It is up 183% announced 1 month prior. So both a short-term and a long-term pop in layoffs. This is correcting after the hiring boom of the pandemic, but comes as AI adoption, softening consumer and corporate spending, and rising costs drive belt tightening and hiring freezes. Those laid off are now finding it harder to quickly secure new roles, which could further loosen the labor market. Now, we've been in a low fire, low hire sort of environment. That might be starting to change, which could signal major issues for the labor market. We'll take a look at a chart in a second. Through October, employers have announced 1,099,000 job cuts, an increase of 65,000 from the first 10 months of 2024. It is up 44% from the 760,000 job cuts announced in all of 2024. And we still have a couple months left to go. A higher number of companies are announcing job cut plans. So, as if the layoffs are not bad enough, not only are they laying off, a higher number of companies are announcing intentions to further lay off. This is primarily due to cuts in government spending. By the way, October's total is the highest month for the month of October, going all the way back to 2003, when 171,000 cuts were recorded. Now, again, the labor market is heavily dependent, as we will see from a post that I did many months ago talking about cuts to government spending. But cuts to federal government spending can have a disproportionate impact on the broader economy. And we'll get to that in a second. Like in 2003, which was the last time we had leveled this many layoffs, a disruptive technology is changing the landscape. Of course, it was the cell phone back in 2003, and it is AI now. Technology continues to lead in private sector job cuts as companies restructure amid AI integration, slower demand, and efficiency pressures. Retail as well announced 2,431 job cuts in October. That is down slightly from the month prior, but the sector remains one of the hardest hit this year. Services sector, remember, the U.S. economy is heavily service-based, primarily service-based, announced 1,990 job cuts in October. This is down significantly from last month, but year to date, the sector has announced 63,000 job cuts. That is up 62% from the same period of time of last year. Warehousing led all industries in October job cuts, announcing 47,878 job cuts, up significantly from the last month. Year to date, the sector has cut 90,000 jobs, a 378% increase from the same period of time in 2024. Nonprofits also impacted by government spending as well as rising costs. They announced some layoffs. Media industry as well, 16,000 cuts. That is up 26% from the first 10 months of last year. Now, why are companies laying off and discharging? Doge impact remains the leading reason for job cut announcements in 2025, cited in 300,000 planned layoffs so far this year. Remember, there's been about a million, so that's about a third of the layoffs, primarily attributed to Doge, to that cost cutting effort in federal spending. Of course, we know annual federal spending is about $7 trillion. And there's a multiplier effect that we will look at in a second. This includes direct reductions to the federal workforce and its contractors. But additionally, another 20,000 cuts have been attributed to what they call Doge downstream impact. And again, that is that multiplier. Cost cutting was another top reason that employers cited for job reductions, responsible for about 50,000 of the announced layoffs. AI was the second most cited factor, leading to 31,000 job cuts, of course, with AI. And not only that, but hiring plans. So intentions to continue to hire. Through October, U.S. employers have announced 488,000 planned hires. That is down by almost a third from the 750,000 announced at the same point last year. So, of course, we have been in a low hire, low fire environment, and this has kept the unemployment rate from going exponential, as it usually does going into a recession. Layoffs and discharges have actually been declining again, as we saw yesterday in the ADP report, that chart that I'd showed before the updated Challenger cuts we got today. Layoffs and discharges had been coming down, but hiring had also been pretty slow as well. We can see again that low hire, low fire sort of environment. But again, if you get a surge in layoffs and discharges, that could spell real issues for the labor market. Now, to the AI issue, I put this chart out. It went super viral, and I just want to remind people, you're probably going to see it a lot. A lot of people posting that chart today due to the AI cited reason in this new Challenger job cuts report. Just want to remind people, I put this out October 1st. A lot of people seem to like my chart. So, anyways, why can't we cut $7 trillion? Why can't we have a balanced federal budget? Well, number one, we don't run a budget. We run continuing resolutions. But number two, there's something known as a multiplier effect. So this gets to that Doge impact, which again, remember, going back to the report, that is one of the leading reasons for job cut announcements this year. Not only direct layoffs and direct reductions in spending, but also what they call downstream impact. Well, I've been vocally fading the Doge effort. And it's not because I don't believe in a balanced budget. It's because I can do basic math. And here is that math. I did this back in February. It's changed a little bit, but not really. So here we can see current GDP, growth rate of GDP, government spending, 36% of GDP. That is total government spending, not federal, which is about 25%. Spending is about 7.5 trillion. That is on budget spending. Current tax revenue is about 5.5 trillion, and the current deficit is about 2 trillion. Well, there's a multiplier effect on GDP, meaning that each dollar of government spending has an increased influence on GDP. This multiplier declines as debt to GDP goes up. Put another way, it increases as debt to GDP goes down. Also, government spending has clearly been propping up the labor market. This was, again, looking back at 2024, with poor private sector job growth and significant increases in government jobs. That had been saving the U.S. economy for 2023 and 2024. This is kind of this is not contested anymore with some retrospect. Given the multiplier effect, if we were to cut $2 trillion in government spending to balance that budget, right, we run a $2 trillion deficit. That would actually take GDP down more by about 3 to 4 trillion. That would end up resulting in a GDP of 25 to 26 trillion. Again, depending on the multiplier that you use, generally accepted to be somewhere between 1.5 to 2.5. It varies. It depends on money velocity. It depends on where the spending is and what certain sectors the spending is going to. Depends on a lot, but you can assume between a 1.5 to 2.5. So here's the math. During the 2008 great financial crisis, as I have pointed out many, many times, during recessions, your revenue goes down and your expenditures go up. And so just extrapolating out Elon Musk's claim of a balanced budget, which is what he was promising. They got nowhere close, by the way. They cut like 1% of total federal outlays. Assuming 2 trillion in spending is cut first, this would initially take spending from about 7.5 to about 5.5. Everything may seem okay at first, but then as the recession hits and expenditures rise, spending would rise back up to 6 trillion. Because again, remember, spending is a large component, about a third of GDP, total state, local, and federal, or about a quarter if you're looking at just federal spending. So therefore, you cut $2 trillion of spending, you're going to mechanically reduce GDP. And here's the math. Using the math, just basic back of the envelope sort of math, tax revenue would decrease by about 25%, fall to about $4 trillion. While you initially cut spending by $2 trillion and seemed to balance the budget at first glance, that second order effect, the decrease in GDP, just because you may not agree with some sort of government spending for some contract or some program you don't like, doesn't mean that the people at that nonprofit don't have a mortgage, don't have a car payment, don't go to the grocery store, don't go on vacation. Hopefully, that downstream multiplier effect is clear. The resulting GDP contraction from balancing the budget would be catastrophic. You would actually end up making the deficit worse. I will link this so people can go through and double check my math. I asked many times for someone to prove it wrong, and no one was able to do it since going all the way back to February. So we can assume that cutting spending was going to have a negative impact, and they only cut 1.5% of the total federal outlays. Imagine if they had cut $2 trillion, which is what they were originally promising you they would do. Now, on this note, the weak labor report today from Challenger, bonds are getting bid. We do have a bull steepener. Of course, expectations of Fed rate cuts are surging. And we also have the S&P 500 down significantly, down today on the day by about 1%. And that move, the soaring in interest rates, in yields and bond yields, 2-year, 10-year, and 30-year, basically reversing almost all of it. So the 2-year has reversed all of its move from yesterday. The 10-year has basically reversed all of it. The 30-year, not so much, still about 2 or 3 basis points to go. The dollar is weakening, and we can see, of course, risk like Bitcoin and the S&P 500 is not doing well. This is quite significant. This is a pretty weak report. And again, this chart may not look so silly. I had originally put this out, by the way, kind of as a joke. I look at TradingView all day, and I'm always pulling up random charts. And I pulled up the job openings report for JOLTS that had come out, the last one. I thought, that looks like if the S&P 500 had continued its 2022 bear market, because I look at charts all day. I have it burned into my memory. And so I thought, okay, I'll overlay S&P. Whoa. And then I remembered that ChatGPT was released at the end of the year in 2022 and just kind of thought it was funny. I don't know. No one really knows. It is too early to say how much AI is really impacting the labor market. But these reports, like the one we got today from Challenger, surveying firms, asking the firms that are laying people off, hey, why are you laying off? And they're saying, Doge and federal spending cuts, which again, this was always going to have a negative impact when so much of your GDP comes from federal government spending, number one. And number two, you have AI. These are the two leading issues. You have also, of course, have kind of general cost-cutting efforts and kind of general softening of demand. But really, the two major issues that appear to be the ones to watch over the next 3 months is going to be AI and, of course, any impacts that might have on the labor market, as well as, of course, continued federal spending cuts. So as long as this government shutdown goes on, we're losing about $18 billion of GDP per week that it goes on. Now, GDP growth was running at close to 4% if you look at the Atlanta Fed Now estimate. But again, if this shutdown continues, GDP could fall mechanically because, again, remember, about a quarter of our economy comes just from the government. So anyways, hopefully that was helpful, and I'll catch you on the next one.